With 30,000 employees and $100 billion in annual revenue, Enron was the model for large corporations at the beginning of 2001. But by the end of the year, it had become the largest corporate bankruptcy in history. Arthur Andersen, one of the Big Five, got the same punishment for its role in the scandal. How did a company that won Fortune's Most Innovative Company Award 6 years running and a market cap of $70 billion suddenly go bankrupt in the span of a few months? Here is a case of major mismanagement, shady dealings, and fraud. The fall from corporate glory experienced by Enron Corp is a cautionary tale of how quickly fortunes may change. Thousands of workers were affected by the company's demise, and it sent shockwaves through Wall Street. In contrast to its peak valuation of $90.75, Enron's share price was only 26 cents on the day before the company filed for bankruptcy on December 2, 2001. Enron was established in 1985 when the two natural gas transmission companies, Houston Natural Gas Corporation and Internorth Incorporated, merged to form HNG Internorth, which was later renamed Enron the following year. Since the early 1990s, when the U.S. Congress passed a series of laws to deregulate the sale of natural gas, the company has not had the sole right to run its pipelines. Through the guidance of Jeffrey Skilling, who joined Enron as a consultant before rising through the ranks to become COO, the company shifted its focus to become a broker for energy derivative contracts between natural gas producers and their customers. The producers were able to protect themselves from the volatility of energy prices thanks to the trades, in which Enron negotiated a fixed selling price for their products in exchange for a fee. With Skilling at the helm, Enron quickly became the industry leader in natural gas contracts, and the company began reaping massive profits from its trades. Over time, Skilling also shifted the company's emphasis from cautious to risk-taking in its trade practices. He recruited the cream of the crop candidates from MBA programs around the country, then fostered an atmosphere where employees were incentivized to close as many deals as quickly as possible in order to maximize the company's bottom line. Andrew Fastow, one of his brightest hires, went on to become the chief financial officer of Enron. Fastow managed the company's finances by investing in increasingly sophisticated instruments, and Skilling was in charge of establishing the company's massive trading operation. Enron's ambitious and rapid growth were aided by the bull market of the 1990s. There were business opportunities in every direction, and the firm was prepared to establish a trading platform for any commodity. Thus, it engaged in the derivatives trading of a wide range of commodities, such as electricity, coal, paper, steel, and even the weather. During the height of the dot-com era, Enron established a division dedicated to online trading. By 2001, this division, known as Enron Online, was handling daily online transactions totaling approximately $2.5 billion. Enron also made an investment in constructing a broadband communications network to enable rapid trading. In the wake of the end of the boom years and the rise of new competitors in the energy trading market, Enron's profits plummeted. Company executives felt the heat from shareholders and turned to questionable accounting practices like mark-to-market accounting to conceal the problems the company was having. This was one of Skilling's earliest contributions. Due to the use of mark-to-market accounting, the company was able to artificially inflate its reported earnings by including gains from trading contracts that had yet to be realized. Mark-to-market, or MTM, accounting was approved by the U.S. Securities and Exchange Commission, or SEC, in 1992. MTM is a measure of the fair value of accounts, such as assets and obligations, that can fluctuate over time. MTM seeks to provide a realistic assessment of a company's or institution's current financial status, and it is a genuine and extensively utilized procedure. MTM is not based on actual cost, however, but rather on fair value, which is more difficult to determine. Some argue that MTM was the beginning of the downfall for Enron, since it allowed the company to record estimated profits as actual profits. The troubled business operations were also moved to what are known as Special Purpose Entities, or SPEs, which are essentially limited partnerships formed with third parties. While it is common practice for companies to transfer assets to SPEs, Enron's handling of the transfer was problematic. By shifting ownership of these assets to SPEs, Enron was able to conceal the true extent of loss from investors. The irony here is that Fastow himself oversaw several of these SPEs. Through it all, Arthur Andersen was not only Enron's auditor, but also a consultant. Former video rental giant Blockbuster was one of many companies caught up in the Enron crisis without realizing it. Enron Broadband Services and Blockbuster teamed together in July of 2000 to break into the booming VOD market. The video-on-demand industry was a good choice, but Enron started recording earnings based on the VOD market's projected growth, which greatly inflated the numbers. After Lay stepped down as chairman in February 2001, Skilling took over as CEO. However, Skilling abruptly resigned in August. and Lay took over as CEO once again. To Lay's dismay, an anonymous memo had arrived from Enron's vice president, Sharon Watkins, who had grown concerned about the Fastow partnerships and warned of potential accounting scandals. By the middle of 2001, the gravity of the situation had become clear, as analysts had begun to delve into the specifics of Enron's publicly released financial statements. Enron's financial statements were already being questioned heavily. Fastow's partnerships were a contributing factor to Enron's shocking announcement to investors in October that the company would report a $638 million loss for the third quarter and a $1.2 billion reduction in shareholder equity. Soon after, the Securities and Exchange Commission, SEC, opened a formal inquiry into the business dealings between Enron and Fastow's SPEs. Arthur Andersen employees then started destroying audit records pertaining to Enron. Accounting fraud details precipitated to a freefall for Enron. Fastow was let go, and by the beginning of November 2001, the stock price had dropped from its all-time high of $90 to less than $12. By agreeing to be acquired by Dynergy that month, Enron hoped to avert disaster. After a few weeks, however, Dynergy decided to pull out of the agreement. Since the majority of Enron's employees' 401k pensions were vested in the company's stock, the news led to a precipitous drop in the price of Enron's stock, which is now trading at under $1 per share. When Enron sought Chapter 11 bankruptcy protection on December 2, 2001, it did so under that chapter. After being found guilty of various charges, many Enron executives were sent to jail. Notably, Skilling and Lay were found guilty of multiple counts of conspiracy and fraud in 2006. Skilling was given a sentence of over 24 years in prison, but only served 12. Lay, who was scheduled to receive a sentence of more than 45 years in prison, tragically passed away before his sentencing hearing could take place. Fastow also admitted guilt in 2006 and was sentenced to 6 years in prison. He was released in 2011. In addition, Arthur Andersen was investigated extensively, culminating in an obstruction of justice indictment from the United States Department of Justice in March 2002. Customers who needed their financial statements to conform to the strictest accounting standards left Andersen for its rivals. They were quickly joined by the rest of the Andersen staff and the rest of the office. Thousands of workers were also let go. Arthur Andersen was found guilty of shredding evidence and suspended from the accounting industry on June 15, 2002. 3 years later, Andersen's legal team convinced the Supreme Court to reverse the conviction of their client on obstruction of justice charges due to improper jury instructions. However, by that time, the company had been reduced to just 200 people who were responsible for handling legal matters. Shareholders also filed hundreds of lawsuits in civil court against Enron and Andersen. Numerous lawsuits were successful, but most investors lost money, and workers only got a portion of their 401ks. Many new laws and regulations were enacted as a direct result of the scandal, in an effort to improve the reliability of financial statements made by publicly traded companies. The Sarbanes-Oxley Act of 2002, the most significant of these measures, established severe penalties for willfully or maliciously destroying, altering, or fabricating financial records. The law also made it illegal for accounting firms to engage in consulting work for the same clients at the same time. That's how it happened. What do you think could be the next Enron? Tell us your thoughts and ideas in the comments below. If you like this video, subscribe and click the bell to get updates on our next videos. Thanks for watching.